Hello everyone, and welcome back to Dr. Tao's Quant Lab. So far, we have priced the ETF as the ultimate tool for a quantitative trader. But there is a dark side to this industry. Hidden inside the mathematics of certain ETFs are structural traps designed to drain your capital. If you buy and hold the wrong ticker, you are not just taking a risk. You are committing financial suicide. Today, we are going to look at the three hidden dangers of ETFs: free drag, contango, and volatility delay. The first danger is the silent killer, the expense ratio. An expense ratio isn't a one-time fee. It is deducted daily from the fund's net asset value. It acts as a continuous negative compound interest rate. Let's look at the math. If you invest $100,000 for 30 years at an 8% return, you end up with over $1 million. But if an active manager charges a 1% fee, your return drops to 7%, you only end up with $761,000. You didn't just lose a 1% fee, you lost all the decades of compound growth on that money. The fund manager legally extracted nearly $250,000 from your wealth simply from holding the assets. This is exactly why quantitative managers almost exclusively use passive, low-fee index funds for long-term compounding. Danger number two happens when you buy a commodity ETF or a futures-based volatility product like UVXY. A major mistake beginners make is assuming an oil ETF actually owns physical oil. It doesn't. It owns financial derivatives called futures contracts. Futures expire every month, so the ETF is forced to sell the expiring contract and buy the new one. If the market is in a state of contango, where future prices are higher than current price, the ETF is trapped in a mechanical nightmare. It is forced to systematically buy high and sell low every single month. Look at the chart in your textbook showing the historical split-adjusted price of UVXY. You will notice the y-axis is logarithmic, meaning each grid line is a 10 times jump. Why do we need a log scale? Because the destruction of capital is so absolute. Since 2016, the split-adjusted price of UVXY dropped from over $8.2 million down to roughly $35 today. If we used a normal line chart, the last decades would just look at a flat line at zero. Let me be incredibly clear. Products like UVXY are strictly for institutional hedging. Quantitative desks use them to temporarily protect billions of dollars from a sudden market crash. A retail trader should never hold this long term. The final danger is leveraged ETFs. These are funds that promise 2 times or 3 times the daily return of an index. Amateurs think if the Nasdaq goes up with 10% in a year, a 3 times ETF will go up 30%. This is mathematically false because these funds reset their leverage every single day. They suffer from volatility delay. Think back to the mathematical proof we did earlier in the chapter. If a stock goes from 100 up 10% and then down 9.09%, the stock ends perfectly flat at $100. But the 3 times ETF goes up 30% to 130 and then drops 27.27%. It ends at $94.55. You permanently lost 5.5% of your money, even though the market went nowhere. This is a volatility delay, and it will destroy your portfolio in a sideways, choppy market. These three dangers, free drag, contango, and volatility delay, are why quantitative traders don't just guess. They build mathematical models. This concludes our introduction to market assets and ETFs. See you in the next Quant Lab.